Good morning, everyone, and thank you for joining us. My name is Jason Cogdell, and I'm here with Laura Bibb. Good morning to you, and season's greetings from our team at ProBenefits to you wherever you may be on this Wednesday morning. It is our tradition as part of our client webinar series, which goes through the year, and we've taken a little bit of a break here the last couple of months because we had to do some special webinars for the implementation of our new COBRA system, much like we moved to a new administrative system for FSA, HRA, and HSA earlier in the year. And for those that are on our new platform, we hope that you're finding that to be effective. And we're certainly pleased with our new systems and the capabilities of those systems as we serve our clients. But it's our tradition in December to do an end-of-the-year compliance update, a look ahead to the next year, and some practical updates on key issues. And that's our goal for today. So our focus for today in this webinar is to dial in on the practical, not the technical so much as the practical, because we know you have a lot going on. Many of you are even in the process of open enrollment right now for a calendar year plan, or maybe you just enrolled for 12/1, or maybe you're looking ahead to your enrollment in March or April. But obviously a lot's going on with you in your business. And so rather than talk to you about some things you may not need to know today, what we want to really do is focus on the practical, what you need to know for the end of 2019 and the beginning of 2020, what considerations there may be from a compliance perspective regarding open enrollment. And then because most of the employers on the session today are our clients for either Section 125, whether POP plan or flexible spending accounts, HRAs or HSAs, we want to give you some brief and practical updates on those benefit models. So we won't be focusing in detail on COBRA today, but for COBRA or transit or any other topic that you may have, your questions are welcome. You can submit them during the session through the question box on the control panel. You can submit to our team at compliance@probenefits.com by email, and we'll get back to you. So your questions are welcome. And as we finish the presentation, Laura and I are going to hang around for about 10 minutes and answer some questions today. So thanks for joining us. And without further ado, we'll launch into some of the topics. The good news about end of the year items is that there are really no specific requirements for most employers. Even though the end of the year is important, obviously it's the end of the tax year, and we as employers will be working on issuing W-2s in January so that we can send the W-3 to the IRS in February. So there are some end of the year requirements from a tax perspective for employers, but from a benefits perspective, the end of the year really doesn't raise its own compliance requirements. So that's a good thing. So for most everyone who's listening today, there is no specific December 31st requirement related to your benefit programs. Now, there are some exceptions. For example, December 31st is the filing deadline for Form 5500s for plans that ended May 31st of 2019. So some employers have a deadline based on their specific plan year, but for calendar year plans or just employers generally, 12/31 does not bring any specific deadline, so that's a good thing. And most of the requirements around 12/31 are related to calendar year plans and open enrollment, and I'll get to that on the next slide. As we look into 2020, the first compliance requirements relate to the ACA reporting as part of the employer mandate and the Affordable Care Act, and the reporting specifically for applicable large employers for the calendar year 2019. Now, as most all of you know, the deadline for applicable large employers to give forms 1095-C, 1095-C is in Charlie, which is due to be provided by applicable large employers to anyone that was full-time for all or part of 2019. That would be on the same deadline, January 31st, as the W-2 deadline. However, last week, the IRS announced a delay, very similar to what they did last year, to give employers another month to give the 1095-C, or for employers that are required to provide a 1095-B as in beta to certain participants in a self-funded health plan, that both of those requirements are delayed until March 2nd. So the employer has another month. Now, the IRS did not delay the deadline for employers to file forms with the IRS, and that's the 1094-C as in Charlie or B as in beta. Those those forms must be filed with the IRS if the employer is filing in hard copy by the end of February, if it's filing electronically by the end of March. So the IRS deadlines did not change, but the IRS does have more time, employers do have more time to give the forms 1095 C or B to employees. There's also some limited relief for small employers that have self-funded plans. I won't get into that now because it doesn't apply to most of you, but if that's something that may apply to you, I'll be happy to share information with you separately. So the ACA reporting deadlines will be the first compliance deadlines in 2020. And then the next deadline, which will be July 31st, and it looks like on the slide I didn't correct that to 2020, July 31st of 2020, not 2019. The PCOR fees will be due for both self-funded health plans and HRAs by July 31st. The plan years that ended in 2019 before October 1st. So good news is the PCOR fee goes away this year. So employers that have self-funded health plans or HRA plans that end in the fourth quarter, this fourth quarter of 2019, you're done. You've paid your last PCOR fee. You don't have to pay one in 2020. For employers that had a plan that ended January 1st of 2019 all the way through September 30th of 2019, will pay the last PCOR fee by July 31st of 2020. July 31st of 2020 will also be the Form 5500 deadline for calendar year 2019 plans. So good news for employers. We don't have a lot of requirements. We don't have a lot of deadlines between now and the middle of 2020. So that's good for all of us. But that's a quick overview of the end of the year and in a look ahead into the first half of 2020 as you set your compliance calendar and know what else may be coming. And if you have questions on any other potential requirements or due dates, feel free to submit a question. We'll be happy to help you with that. Now, open enrollment. Whether you have gone through open enrollment just now for 12/1, whether you're going through it currently for 1/1, or whether you have open enrollment coming up in early 2020, I think it's always helpful to take a big picture look at enrollment and the new plan years for your health and welfare plans to see what do we need to do from a compliance standpoint. So obviously enrollment, for the most part, is what plans are we offering? Let's communicate those. Let's get employee elections. But there are some compliance steps we need to make sure are covered as well. First of all, not only for health insurance, which is very important for applicable large employers who are subject to the employer mandate, but really all benefits, it's advisable and a best practice for employers to document elections and waivers. Hopefully you're getting elections or waivers either in writing or electronically through a system, but the better documentation we have of what people elect or what they waive, that helps us because we've got a written record or an electronic record in case there's ever any challenge or review by a third party regarding what we offered, when we offered it, how much was the coverage, et cetera. So I think documenting election and waivers is a best practice and is a compliance step, even though it practically is kind of a part of what we do during open enrollment. For COBRA, it's important for us as employers that are subject to COBRA to know that COBRA participants have open enrollment rights. So someone who terminated or had a reduction of hours at a previous date and has remained active on COBRA, that person has open enrollment rights. They can add a person to COBRA during open enrollment or drop one or elect a different benefit plan option during open enrollment. So that's something that not a lot of employers know or pay attention to, but it is true related to COBRA. For your Section 125 plan, you're going to make sure that the written plan, the summary plan description for your 125 plan includes all of the benefits that are pre-tax. And if you've changed benefits, so for example, you've added a vision plan or you've changed eligibility for your plans that are paid for by employees with pre-tax deductions, that your Section 125 plan has been updated. That is something that we want to make sure is consistent with what we're doing and how employee elections and payroll are being handled. For employers that have group health plans, the SBC, Summary of Benefits and Coverage, must be provided or made available electronically to participants in that plan. And there are other required notices or disclosures that go to new hires or existing participants in addition to just the SBC or the summary plan descriptions. And we want to make sure that we take care of any notices or disclosures either at open enrollment or during the plan year. And of course, if you as the employer have added a new benefit I mentioned a moment ago group vision, or if you've added a telemedicine benefit or an employee assistance program, you'll want to make sure that any compliance steps have been taken. Maybe that plan needs a summary plan description. Maybe that plan needs to be added to your Form 5500 if you're a large employer with more than 100 participants. Maybe, again, it needs to be added to your Section 125 plan or an existing ERISA wrap document. So this is a very quick and dirty overview of open enrollment, but I think it's important to know that during an open enrollment, not only are we getting benefit plans enrolled and launched for the new plan year, but we're making sure that any of these required steps are taken so that that we've covered ourselves from a compliance standpoint, in addition to just getting the insurance plans or the tax benefit plans set up and enrolled. Again, we got some questions coming in, and more are welcome. So feel free to keep submitting those, and we'll get to those as we go. In every compliance update, it's always helpful to do the necessary in addition to the helpful. And one of the necessary items for people that do what Laura and I do is providing an update on the Affordable Care Act. And this is your annual update to say that nothing has changed, that the ACA remains the law of the land, that Congress has not done anything significant to affect the Affordable Care Act. The good news for employers is it's status quo again in 2020. All the major provisions of the Act have gone into effect, except for the Cadillac Tax, the tax on high-cost health benefits, which is still several years away if it ever comes to fruition. So no new items for 2020. I think that's good news for all of us. Just as with 2019, in 2020, there's no penalty on an individual who doesn't get health coverage. So you, me, spouse, neighbor, parent, cousin, pet, any one of us who does not get health coverage, either through the employer, through the marketplace, through an individual plan, through Medicare, through TRICARE, or any other options, will not be penalized at tax time. 2019 was the first year that relief was implemented for the individual mandate that started in 2014, and that relief will continue indefinitely, 2020 and beyond. There is no relief for employers, however. Employers do still have to comply with the employer mandate, which means not only offering coverage to all 30-hour or more employees, but completing the ACA requirements that I mentioned earlier that are due in early 2020 for the 2019 calendar year. For employers that are subject to the mandate, applicable large employers that had 50 or more full-time employees plus equivalents during the prior calendar year, those employers will have to ensure affordability of health coverage in addition to offering coverage to full-time employees. And the affordability percentage for 2020 is 9.78% for those of you that haven't looked ahead at that already. And even though the law hasn't changed, it does appear that sometime in 2020, unless it gets moved all the way to 2021, that we will have another Supreme Court decision, if they choose to hear the case, on a federal action that started in Texas and is currently in the next highest level of the federal judicial system, the Circuit Court of Appeals. And that's something that benefits geeks like Laura and I are watching right now. The Circuit Court of Appeals is expected to make a decision at some point in early to mid 2020, with it going to the Supreme Court for potential decision later. So just the same way we've seen Supreme Court decisions in 2012 and 2015, I think it was, we'll likely see another one to see if the ACA survives one more time. But other than that, no developments or changes to the ACA. One thing I do want to mention before moving on to other topics is that the IRS is continuing to enforce player pay, and employers are being served with notices from the IRS of potential penalties, either for failing to offer coverage, failing to offer affordable coverage, failing to do the reporting. Employers are having to deal with the IRS and pay penalties. So if your company hasn't been put on notice of penalty, outstanding. If you're not subject to the mandate, outstanding. But just know other employers in your industry, other employers in your area are having to deal with these issues. So it's not as if these rules are on the books, but they don't matter. These rules are on the books, and employers are paying tax penalties for failure to offer coverage in past years. The IRS currently is working on enforcement of the 2017 and 2018 plan years. So the law continues to be real and continues to be a factor for employers. In terms of a recent development, in the last month or 2 months, the Department of Labor has proposed a new rule for electronic disclosure. Some of you know, particularly you large employers know that while we as employers certainly prefer electronic distribution of required notices or summary plan descriptions, the rules are far out of date when it comes to being able to provide things via the web or via email or app as we communicate with our plan participants. The DOL has released a new, updated, more modern rule. The current rule, proposed rule, only applies to retirement plans, but it almost certainly will be extended to health and welfare plans soon. But this improves upon the safe harbor that's been in effect for many years regarding electronic distribution. So just know we as employers have additional options for electronic distribution, and hopefully those options will continue to increase and become more employer and employee friendly in the future. In terms of another recent development, the IRS has finally gotten through all of the limits and the thresholds and the amounts that will apply to benefit plans in 2020. And I'll let Laura address the FSA and HSA limits as we transition into looking at Section 125, pre-tax benefits, and FSAs.
Thanks, Jason. As many of you know, just to provide a brief overview on Section 125 plans, the IRS does allow employers to offer benefits to be paid pre-tax by employees. So you can have those plans set up where employees can pay for the cost of their coverage on a tax-free pre-tax basis. Those contributions are tax-free, though only if offered through a qualifying plan. And those plans have various different names that they're referred to. You can see here, Section 125 is the same thing as a cafeteria plan, is the same thing as a flex plan or flexible benefits plan. So those of us in the industry and employers will often refer to these by different names, but all of these names really mean the same thing. And again, if an employer allows employees to pre-tax the deductions for benefits, this type of plan, a Section 125 plan, has to be in place. And the pre-tax premiums for eligible benefit options include group insurance plans, so your medical, dental, vision, et cetera, flexible spending accounts, and also HSAs. So if you have one of these plans in place, the employee contributions are exempt from all taxes, and then employers are exempt from FICA match on the employee deductions. So there is a good deal benefit from having one of these plans in place if your employees are contributing towards the cost of their coverage. There are two basic types of Section 125 plans. There is the variety of a premium-only plan. This is often referred to as a POP plan. These are plans that solely exist for the pre-tax payment of insurance premiums or contributions to an HSA. So that's the only feature under a POP plan, as the name implies, premium only. The other design of a 125 plan is a pre-tax plan, so a premium payment feature plus some version of a flexible spending account. So those flexible spending accounts come in various forms, and we'll talk a little bit about that in a minute. But these are the two basic type of plan designs that we see. And so in order to have a Section 125 in place, you have to have a formal plan. And what that means is that you have a plan document and an SPD. This is a requirement to have this type of qualifying plan. There has to be some legal documentation of it. The tax-free benefits aren't allowed for everyone, but we can provide tax-free benefits for employees legal spouses and qualifying dependents. And what this means is that the employee can pay for the cost of their coverage and also the cost of coverage for their legal spouse and their dependents, or can seek reimbursement of the spouse and dependents qualifying health expenses through the health flexible spending account. Ownership participation is limited. If you have an S Corp, LLC, or a partnership, the owners of those entities cannot participate in the Section 125 plan. That includes the flexible spending accounts. One thing that we commonly see is mid-year entity changes or increases in S Corp ownership. So if you have an individual who was a less than 2% owner of an S Corp who now becomes a 2% or more owner, that can create some issues. Or, for instance, if you move from a C Corp to an S Corp mid-year, we need to talk about that because both of these instances do create the need for adjustments because you've had people who were previously participating who, because of these changes, are no longer eligible. So if that comes up in your situation, or if it's something that's being considered, get in touch with us so we can talk about planning for that, or if you discover that that has happened, let's talk about what needs to be done to correct those elections. So the flexible spending accounts I mentioned, there are actually two options. A health FSA, and this could be a full purpose health FSA, or it could be a limited purpose health FSA only reimbursing dental and vision. But generally health FSAs, we're looking at reimbursement of medical, dental, and vision expenses. There's also a dependent care FSA for work-related child care expenses. We're not going to talk about the dependent care health FSA in great detail today because really there's not much new there. The maxes are still the same, still $5,000. But just know that is a type of a flexible spending account. The health FSA is in place to reimburse eligible out-of-pocket health expenses. So it's going to depend on what type of health FSA, whether it's limited or full purpose, on what expense can be reimbursed. But generally, it's medical, dental, and vision expenses that are not covered by some other source. So you can't double dip. The expense can't be reimbursed both by the insurance plan and the health FSA. But if there is some portion of the expense that has not been covered, then it can be reimbursed through the health FSA, provided that it's an eligible expense. As Jason mentioned, the IRS has released the 2020 year maximums for health FSA. As expected, there was a $50 increase on the plan year maximum from 2019, so our 2020 maximum is $2,750. Now, this does not include employer contributions. So this plan year maximum is the maximum allowed employee contributions. The IRS does not dictate what minimums are, so these are set by the individual employer. Some employers don't have a minimum, others do have a minimum, but that's up to the employer to set based on how they want to administer the plan. I do want to note that the health FSA plan year maximum should be noted in the SPD for your flexible benefits plan. And as a reminder for any ProBenefits clients, if you're using the plan year maximum, so either the $2,750 for 2020, or if you're still using the 2019 maximum because you're not a calendar year plan, our SPD document is designed to automatically increase with the plan maximum when it's indexed. So your plan wouldn't have to be updated for the IRS max increases. Now, there may be other plan changes that you've made that would require an update, but the plan maximum alone is not going to require an update. And then finally, there is an option for a $500 carryover. This is a feature that's not new, but we do have employers that may not have implemented this. But that carryover option is in place and can be part of your plan design if your FSA doesn't have a grace period. So Jason's now going to walk us through the HRA overview and give us some updates on that front.
Thanks, Laura. We've had some good questions so far, and you all are welcome to keep submitting them. One follow-up comment to Laura's remarks about the summary plan descriptions for 125 plans, either a premium-only plan or an FSA plan. You know, one thing during this busy renewal season, one thing that she and I spend a lot of time doing is updating documents for our clients, whether the client's made a change for the year, or whether it's a new plan being implemented. If you're listening to this session today and maybe you're a client of ours for HRA or COBRA or HSA and you're not sure about where you stand with 125 compliance, that's something we'll be happy to help you with. That's something that, you know, we've got a simple and easy service, can get the documents in place and assist you with your premium only 125 plan, or if you have flexible spending accounts. Just know that our assistance is available. That's one of the things that we do and do well, so we'll be happy to assist you. Looking from FSAs to HRAs, as Laura mentioned, and HRA stands for Health Reimbursement Arrangement. The primary difference between Section 125 plans and HRAs is that HRAs are employer funded. 125 plans are designed so that whatever the employee pays toward premiums or flexible spending accounts from the employee's own income is handled on a tax-free basis. HRAs are designed so that employers can choose one or more categories of expenses and fund them with employer money that the employer makes available. If the employee experiences and incurs eligible expenses, the employee can be reimbursed from the employer money tax-free. If the employee doesn't incur expenses or doesn't submit expenses, the money stays with the employer. HRAs are not new. They've been around now for 2 decades, and the great advantage of an HRA is flexibility. That if the employer wants to use employer funds to take care of a single category expenses, example, and the most common type of HRA is a deductible reimbursement plan, where the employer wants to fund all or part of the deductible under the group health insurance plan that the employee enrolls in. That's the most common HRA. The employer can do that. The employee who incurs deductible expenses for self or family can be reimbursed tax-free from the plan. The same applies for coinsurance expenses, out-of-pocket expenses, dental expenses, vision expenses. HRAs are most commonly linked to the group health plan and provide eligible reimbursement up to a maximum that's set by the employer. So the employer has nearly total flexibility when it comes to how much will be paid, when it will be paid or funded, which expenses can be reimbursed by the plan. And HRAs have great flexibility, and they're used by employers to accomplish a variety of purposes and goals for the group benefit plan. Again, the most common model is a deductible reimbursement plan or a coinsurance reimbursement plan. Some employers use HRAs for specific purposes. Maybe the employer doesn't have a group dental plan, so it sets up an HRA and puts in a dollar amount where employees, spouses, dependents can get reimbursed for out-of-pocket dental expenses. Some employers do the same for vision. Some employers do the same for prescription drugs. The beauty of the HRA is it can be designed for one single purpose, or it can be designed to reimburse a lot of expenses the same way that a health FSA would, or a health savings account. Now, there have been some changes, and because of some recent changes in the law that will apply to 2020, I want to provide a big picture overview of the different types of HRA models that are allowed by the law in 2020 and beyond. So if you're an employer who sponsors an HRA, currently your model will be on this list. If you're an employer that doesn't sponsor an HRA, you'll just know these are the types of plans that are allowed by the law. Again, the most common type of HRA is a plan that's linked or integrated with the group medical plan, so that when employee John Smith enrolls in the group medical plan, he also gets the HRA, whether that's a deductible reimbursement plan or a coinsurance reimbursement plan, or a plan that reimburses a specific category of copays for specialist visits, for example, or prescription drugs. So that's the most common model, and that is still allowed by the law. The second type, as I mentioned already, is the single purpose or dual purpose HRA. That's just for dental, it's just for vision, it's just for a specific type of medical device or expense that may be beneficial to employees. Another type of HRA is the retiree only HRA. Some employers, most commonly government entities or nonprofits that have employment agreements in place with individuals to provide retiree coverage upon separation or retirement, the retiree only HRA is one that can reimburse not only medical, dental, vision expenses, but it also can reimburse insurance premiums, which regular HRAs cannot do. So the retiree HRA is a model. Starting in 2017, a new model came on the scene, the Qualifying Small Employer HRA, or QSE HRA, which allows small employers under 50, not subject to the employer mandate, to have a plan, if it doesn't offer group medical, dental, or vision insurance, to have a plan that reimburses premiums or out-of-pockets expenses up to certain annual maximums, which are roughly $5,000 for someone with individual health insurance coverage or $10,000 for someone with family coverage. A QSE HRA is a model that's used to a very limited extent by very small employers, nonprofits, churches, and other entities that do not have group coverage. Recently, in 2019, two new models have been introduced by the law in response to a presidential executive order that was issued about a year and a half ago. One of those is the new individual coverage HRA, which allows an employer of any size to establish a plan that can reimburse individual or marketplace premiums. This is a model that will be new for 2020. In the interest of time, I will not go into detail other than to say this model is available to employers of all sizes, but there are a number of considerations that apply particularly to employers that are applicable, large employers subject to the employer mandate. And similarly, there's also a new accepted benefit HRA that would allow an employer of any size to establish a plan that includes not only dental and vision, but also medical expenses, even if that employer does not have a group health insurance plan, or if the particular category of employees are not eligible for the group health insurance plan. So these are new models. These are models that we'll talk about in more detail later, but we tend to get questions from employers and advisors on these models, and we're certainly happy to help you with information about these models. But the big picture view of HRAs is that employers have options and employers have flexibility. Again, these models are entirely funded by the employer, with some minor exceptions for these new 2020 models. These are entirely employer funds. So typically conversations we have with an advisor and employer that relate HRAs are the employer has a specific goal that it wants to accomplish, either for all employees or for full-time employees or for retirees, for example. And the HRA is one option for the employer to use employer money to accomplish that goal. One beauty of an HRA is that money that's not paid through the plan to participants reverts back to the employer and helps fund the plan for the next year. So utilization is a factor, and employees that don't use it or don't incur expenses don't get the benefit of the plan. So there is a lot to be said about HRAs and the different ways that the flexibility of these plan models can be used by employers. For now, that's enough. I want to make sure, in the interest of time, we get to HSAs, the fastest growing benefit in America, and one that we assist employers with in various ways. So, Laura, HSAs.
Thanks, Jason. One of the interesting things, I think, when you're looking at these different types of accounts is their names, and thinking about how these accounts are supposed to operate. And I first talked about the flexible spending accounts. It's a spending account versus HSA's health savings account. So the HSA is really designed to allow the employee or the individual account holder to save. So it may not necessarily be an account that the employee is spending. They're saving, and we'll talk about that a little bit more as we go along. But the HSA is generally a trust or a custodial account the employee, again, similar to the FSA, is using pre-tax dollars to pay for eligible medical expenses. One difference with the HSA, again, it's a savings account. So the contributions, growth, and even the distributions for medical expenses are all tax-free, provided they're qualified expenses. One additional caveat feature that makes HSAs different is it's an individual account. It belongs to the participant. It follows the participant wherever they go. So we're not talking about a benefit where we have to look at COBRA with an HSA. So when a participant terminates, this account is going to follow them wherever they go. The contributions are generally non-forfeitable, so once they go in, they're in. There are some exceptions to that, but that's the general rule. And employers aren't required to participate, aren't required to contribute to a health savings account, but the employer can contribute if they are interested in doing that. So health savings account eligibility it can be pretty complex, but it's generally determined on a monthly basis. So we're going to look at the HSA account holder on a monthly basis to determine if they remain eligible to contribute or receive contributions to an HSA. In order to be eligible, the individual has to be covered under what's referred to as a qualified high deductible health plan or qualified HDHP. These qualified plans have to meet minimum deductible and maximum out-of-pocket requirements that are set each year. We've got the 2020 limits set here for the minimum deductible. The minimum deductible, there was a $50 increase for self-only coverage from 2019, and then a $100 increase for the family deductible for 2019. So if you're putting one of these plans in place, or you currently have a HDHP, you want to make sure that you're aware of these limits and that your plans are complying. The out-of-pocket maximum increased by $150 up to $6,900 for self-only, and then the family out-of-pocket increased by $300. So a little bit bigger of an increase there. One great feature of an HSA, especially if you have an S Corp or an LLC or a partnership, is that unlike a health FSA, eligible individuals include owners. So owners of those entities that couldn't participate in a flexible spending account can participate in a health savings account. So it's a way for those owners to set aside money to be able to reimburse eligible medical expenses. One group of participants or individuals that aren't eligible are Medicare recipients. So these are people who are actually enrolled and receiving Medicare benefits. Now, they are not eligible to contribute, but they are eligible to have a health savings account and continue to use the money that's in that account. They just can't make further contributions. So there are other types of disqualifying coverage, including a full health FSA that reimburses all medical expenses, or other non-qualified coverage, insurance coverage, including you may have a high deductible health plan that doesn't meet the limits that are prescribed by the regulators, and if that's the case, that wouldn't be qualifying coverage. So if you have a situation with someone who's getting ready to enroll in Medicare, that's an area where you can take a look at this and make sure that you're looking at their contributions and reach out to us and let's have that discussion about what needs to happen with those Medicare beneficiaries. So the contribution limits have also been announced for 2020. These are the contribution limits for self-only and for family. There were some slight increases from 2019, $50 increase for self-only coverage, and then a $100 increase for family. And then individuals who are 55 and older can make an additional $1,000 catch-up each year. So the contribution limit, if you're eligible for this catch-up contribution, is the self-only or family, whichever coverage they're enrolled in, plus the $1,000 additional dollars. Again, the maximum contributions determined monthly. So going back to my example of someone who enrolls in Medicare, they are ineligible or become ineligible to contribute in the month that they enroll. So if you discover a contribution error or think there may be an error, give us a call or email us and let's talk about it. We see that quite frequently if there's a situation where an employee has contributed too much, and we can help walk through that scenario and what needs to happen to correct that. There is one exception to the maximum contribution rule. For a full year contribution, you can set up your plan so that participants can make a full annual contribution if they are HSA eligible on 12/1. They do have to remain HSA eligible for a full calendar year following that, or otherwise there are tax consequences. The distributions from an HSA, again, are tax-free if they are for qualified medical expenses. There was a recent executive order back in July, and along with an IRS notice about preventive care services. There was a expansion on preventive care services that can be covered by the underlying HDHP before the deductible is met without jeopardizing HSA eligibility. And I'm not going to go into that in great detail, but just to give you a little bit of information, as long as the preventive care is prescribed to treat an individual who's diagnosed with a listed condition. So there's a list of conditions like heart disease, diabetes, asthma, depression, chronic conditions, and that prescription is to prevent the exacerbation or development of secondary conditions from that disease. Then the underlying plan can cover that preventive care services expense. But if you have any additional questions, feel free to submit those and we can address those after the seminar today. There are very few restrictions on distributions. Again, you don't have to be eligible to make HSA contributions in order to receive distributions. So if you previously had an HSA, but you're no longer eligible to contribute, you can seek reimbursement for expenses that are qualified. The only caveat there is that the expense has to be incurred after the HSA is established. So you can't submit for reimbursement of expenses that you incurred prior to when you started your HSA account. There is no limit on when those distributions can occur. So one practical tip for account holders is similar to the shoebox method that we've all heard about with the flexible spending account, but HSA account holders can save their receipt and seek reimbursement at a later year. So you may have someone who really wants to let their account grow. They're not going to be tied down by plan years as you would be with an FSA. So they can let their account grow and then submit those expenses at a later date. And what would an employee benefit be if there were no reporting requirements? Have no fear, we have you covered, or the regulators have you covered. There are HSA reporting requirements. In the interest of time, I'm not going to go into these in great detail, but we've broken them down here. There are employer requirements, there are account holder requirements, so this is the individual participant, and then the trustee or custodian also has reporting requirements. And Jason, are there any other questions we need to address?
Laura, we have covered most of the questions. There are a few more. In the interest of time, we'll move toward a question and answer session off the audio here. I do want to confirm that we will be providing a recording of this session in YouTube format in case you weren't able to listen to all of it, or you have a teammate that may benefit from this. We'll, of course, provide a copy of the slides as well. Your questions are welcome now or later. If you're submitting by email, send to compliance@probenefits.com or simply reply to the webinar email that you received. If you would like to hang around and submit a question through the question box. Laura and I are going to be around for about 5 to 10 minutes to answer some of the remaining questions. So we'll be happy to. I think we've gotten most, or I believe close to all of them answered so far. And the final word I'll share as we go, not only do I hope you and your team and your family have a wonderful holiday season, but if there's any way that we can assist you in 2020, we will. Our full efforts are focused on administration and compliance of Section 125, FSA, HRA, HSA, COBRA plans, and we'll even maybe help you with transit if somebody twists their arm enough. Laura and I are heavily involved in our ERISA compliance services, which include Form 5500 preparation for large employers and WRAP SPD preparation. We have a third member of our compliance team, John Caldwell, but all of the ProBenefits team, which is 35 strong in North Carolina and various points beyond, is focused on helping employers and advisors in any way that we can regarding benefits administration and compliance. So thank you for your time today. Again, please feel free to hang around for a few minutes if you either would like to or have submitted a question that has not yet been addressed in writing. Otherwise, hope you have a great day, and we'll talk to you soon.